Ever pondered on how China's dollar strategy influences global trade? It's a fascinating web of international finance that we're about to unravel. China, with its vast reserves of the almighty dollar, has a unique strategy. Rather than reinvesting in the US markets, which could lessen the US trade deficit by a tenth to a third, it lends these dollars globally. This amplifies future dollar demand as borrowers must repay in dollar-denominated debts. Yet this approach of reduced dollar inflows could lead to a dip in US asset prices, a scenario that clashes with the economic goals of the Trump administration, despite its emphasis on Main Street over Wall Street. Now consider the tactic of imposing tariffs to address trade deficits. It's a bit like a double-edged sword. On one hand, it puts immediate economic strain on businesses due to increased costs. On the other, it could pave the way for structural reforms like reshoring manufacturing, building energy infrastructure, and retooling supply chains. However, these changes don't happen overnight. They take years, even decades to materialize. The US finds itself in a tough spot, trying to rebuild industrial capacity, secure skilled labor, and boost energy production, especially in sectors like steel. The financialized economy of the US is also a precarious house of cards. Global dollar shortages could compel foreign entities to offload US assets, triggering market illiquidity. This mirrors crises in emerging markets, where capital flight puts pressure on both equities and bonds. Measures like austerity or tax hikes to curb deficits could inadvertently dampen financial markets and tax revenues, given the economy's dependence on asset-driven growth. Moving on to the long-term debt cycle, post-2008, sovereign debt has taken the place of private debt as the primary concern. With an aging population, rising interest costs, and political resistance to cut entitlements like Medicare and Social Security, deficit reduction faces significant headwinds. It's argued that meaningful fiscal correction may not be on the horizon until the 2030s, perpetuating vulnerabilities. Lastly, geopolitical and inflation risks add another layer of complexity. Targeting trade partners like China is a tricky business due to their robust industrial base and financial leverage as creditor nations. Tariffs may trigger inflation for specific goods such as Chinese imports, but could also suppress economic activity. Sustained inflation requires monetary expansion, although productivity gains might offset this. In the grand scheme of things, rebalancing global trade and fiscal health involves navigating immediate discomfort for long-term gains. The structural inertia and financial interdependencies present significant challenges. The administration's aggressive trade policies could destabilize markets, highlighting the tension between rapid economic shifts and the slow reality of industrial transformation. In essence, the world of global trade and finance is a complex and intricate dance. It's a continuous balancing act between maintaining economic stability and driving growth. And as we've seen, the ripple effects of one nation's strategies can have far-reaching implications on the global stage.